Welcome to Illuminati Silver. We tell you the truth about silver. Today is Saturday the 7th of August 2021, and we're publishing our view as to why gold and silver prices crashed yesterday and what this could mean for gold and silver prices moving forward. But before we do that, a quick shout out to the video we produced earlier today, which is our regular gold and silver weekly update, and we've placed a link below. So we suggest you watch both videos in order to get an overall feel as to where we believe prices are heading in the near future. So with that in mind, let's take a look. For the past month or so, gold and silver prices have been broadly range-bound, which, apart from yesterday, we saw gold moving within a relatively tight band of between $1,794 and $1,834. That's just $40. Silver doing similarly over that period of just under a $2 band of between $24.53 and $26.48, though most of that time silver traded around but above the $25 mark. Now this past week, gold traded at or marginally above 1800, at one point reaching 1832, and silver comfortably above 25 and at one stage actually hitting $26.02. Now we admit that since gold's all-time high on the 6th of August 2020 at $1,176, and silver's 8-year high of $29.59, which we saw on the 1st of February 2021, these precious metal prices have been in broadly a slow but discernible downtrend. This is why we have for many months condemned those pumpers calling for $100 silver and $5,000 to $10,000 gold, where the most we could see really happening at the very best was $35 silver, and I think we often said we'd be quite shocked if it goes above 33, and 2,300 gold eventually. And even those now, we can see, were indeed extremely optimistic forecasts. Well, at least so far, because they were the sort of figures we predicted for the end of the year. What is concerning for most of us in the gold and silver community, if we are telling the truth that is, that we have a US national debt clock reading of $28.6 trillion, plus central banks around the world have been purchasing between them hundreds of billions of dollars of government bonds and mortgage-backed securities every month, and interest rates have been at all-time lows and in a number of countries in negative territory. And despite all of this, gold and silver prices continue to fall. And the non-farm payroll report announced on Friday was the last catalyst required to push gold and silver out of their recent tight comfort zone, and fortunately for holders, downwards. So let's take a look at those figures and see why such a knee-jerk reaction occurred. Or is it knee-jerk and an continuation of a downtrend? Now, until recently, economic data for most countries have been on an uptrend, with output increasing, GDP figures rising, and unemployment reducing, though we are still far off pre-pandemic levels, and we'll show this in a moment. That said, the improvements were broadly uninspiring, especially considering the amount of central bank stimulus and subsidies and furlough payments and stimulus checks businesses and individuals were receiving from their respective governments. In fact, in recent weeks, we've seen central banks make various excuses as to why they would allow higher inflationary figures to occur, as they deem them to be transitory or temporary as we come out of lockdown, thereby suggesting that any fears of early tightening, whether by way of reducing or paring their bond buying, or raising interest rates, was going to be some way off, well into the distant 2022 and 2023. In order, though, not to let the dollar slump dramatically, or the equity market bubble to expand at exponential levels, they introduced into their rhetoric the possibility of future discussions concerning stimulus reductions later this year. At least sometime, we thought, after the 21st, 22nd September 2021, which is when their next FOMC meeting is held. Now, at the time, no decisions would be expected at that meeting, just confirmation that discussions would take place. This, therefore, created an environment for dealers, economists, and analysts to second-guess what the Fed and other central banks will do and when they will do it. Well, yesterday, here comes the non-farm payrolls report. The report for June 2021 provided a jobs growth figure of 938,000 new jobs, which was both positive and extremely bullish. However, market expectations for this month was another positive rise of around 845,000 new jobs. The ADP report, which came out on Wednesday, was itself disappointing, coming in at 330,000 jobs compared with expectations of 653,000, and therefore, to some degree, the market was bracing itself for a slightly disappointing non-farm payroll figure. What would have been classed as disappointing anything below that 845,000 new jobs? Well, we can see the reaction when the figures were announced. They actually came in at 943,000 new jobs for July, even higher than June's 938,000, which, in view of what I've just said, was quite a shock. Then, to further support or underlie this, the unemployment rate fell from 5.9% in June to 5.4% in July, even when the most bullish of expectations expected it to fall to 5.7%. And in addition to that too, average hourly earnings also came in at a growth rate of 0.4% compared with an expected 0.3%. So these three factors combined immediately on announcement pushed the dollar higher, and the 10-year Treasury yield rose more than 5 basis points. In an interview with Kitco News, RJO Futures senior commodities broker Danielle Pavilonis said that, quote, "This jobs number is bullish for the US dollar and is pushing rates higher, which has an inverse reaction for gold," unquote. That almost proved to be an understatement, to say the least. Gold and silver prices fell immediately on the announcement, with gold falling some $50 and silver over $1 within just a few hours, and both only marginally closing above their day lows. Gold itself closed at $1,764, some $5 above its low of $1,759, and silver closed at $24.36, with its low being $24.23 for the day. The market fear now is, of course, that if the next job figures are also very positive, then the Fed's FOMC meeting on the 21st and 22nd of September could actually announce its tapering of its bond buying program, and bring forward, at least declare, a forward time for raising rates. Now, before we go into the technicals for gold and silver, we shall highlight the potential problems with that scenario. Firstly, any such announcement will seriously dent the equity market. In fact, if the job figures are good, the market may indeed hit equities in anticipation, which seems ironic, doesn't it? A confirmation could lead to a rout, and the Fed will be in the same position it was in a few years ago when it had to backtrack on its rate rising and reverse their move. Secondly, although the unemployment rate declined 0.5% to 5.4% in July, and the number of unemployed persons fell by 782,000 to 8.7 million, and are therefore down considerably from their highs at the end of February to April 2020, as a recession, we have to put into perspective that they still remain well above their levels prior to the coronavirus pandemic, when the unemployment rate stood at 3.5% and 5.7 million people out of work. So you're looking at 5.4% compared to then 3.5%, and 8.7 million out of work compared to then 5.7 million. So you can imagine how high the non-farm payrolls have to be next month and the month after to come anywhere near close to the Fed actually tapering or raising rates. Simply not going to happen in September, for sure. Thirdly, the Delta variant of COVID-19 is rampaging not just across the US, but across the globe as a whole. This in itself is going to at least retrain some economic growth and public spending. Stimulus checks have broadly been stopped or reduced, and without further additions, we simply cannot see sufficient growth occurring over the next month or two to reduce unemployment by at least another million, or bring the rate down into the late 4%, which is what will be required before the Fed can even contemplate the mildest of tapering. All that said, however, the US economy, if by comparison, and this is important, improves more than its European and Western counterparts, then we could see a further strengthening of the US dollar compared to those other basket of currencies. And this, unfortunately, for holders of gold and silver, will act as a headwind. Now, with that said, let's look at the technicals and the potential technicals for gold and silver. This is quite a long video, but these points are important. The bearish scenario is if gold falls beneath 1754 and the then psychological support level of 1750, which is where we are really pitching this. Then we could indeed see a retracement to the next Fibonacci level of 1716. And if that breaks, lower again to $1,680. Now, if that breaks, it would be serious indeed, because then, frankly, 1,500 cannot be ruled out. And we will then, if that does occur, forget any prospect of $2,000 gold by the end of the year. The bullish scenario is that if gold can move above 1774, and we could see a move initially to 1789, it's likely then to move again to between 1795 and up to 1808, where the 20-day moving average rests. Not a huge rise compared to the potential fall. Note that, please. Short-term momentum has turned negative as the fast stochastic generated crossover sell signal, and the medium-term momentum has also turned negative as the MACD generated a crossover sell signal. Now, silver at $24.36 has support at $24.20, $24, $23.80, and then $23.50 below that again. If $23.50 is broken to the downside, frankly, you cannot rule out $20. Of course, there will be a number of supports in between those two figures, but it will be in the sights. If, however, silver can break through the $24.50 level to the upside, we then have the next resistance level at $24.70, followed by $25, and then the 20-day moving average of $25.40. we actually struggle to see it going much beyond that. That said, for this reason, short-term momentum has turned negative, and so has medium-term momentum, both generating a crossover sales signal. So where does this leave us, not just for next week, but frankly until the next Fed meeting in late September? On the one hand, we can contemplate a slight recovery, thinking that the correction has been overdone, especially for silver, as if the economy is improving, then surely the industrial demand for silver must surely rise. So even if both are in a price downtrend, we should expect silver to perform better. We'll mention why that may not be the case in a moment. We have to say that if gold does break decisively below 1750, even with that advantage, if it does exist, it will still drag the silver price down with it. Now, the US dollar index is standing at 92.8. It has been higher recently, and we should not be surprised to potentially see it rise above 93 again, to at least 93.10. And short term, this will be negative for gold and silver. In fact, Bloomberg reported yesterday the following, and we'll quote them. Platinum dropped to a 7-month low as the spread of the coronavirus dents the outlook for industrial commodities, while a Federal Reserve official indicated the central bank is on course to taper stimulus. The metal used in catalytic converters fell for a third day as the spread of the Delta strain punctures the narrative of a rapid global recovery. China is facing a growing outbreak that's prompted analysts to review economic growth projections, while case numbers are climbing from Tokyo to Sydney and in parts of the United States. Platinum has tumbled more than 20% from this year's peak in February as a computer chip shortage curbed auto production, and increasing electric car sales cloud the medium to long-term consumption outlook. Investment demand also has waned, with exchange-traded funds backed by the metal platinum falling last week to the lowest since February, and money managers cutting their net bullish bets to the lowest in almost 9 months. Platinum has come under pressure amid concerns about the Delta variant and production misses by car manufacturers due to supply chain issues, said Wayne Gordon, a strategist at UBS Group AG. The traditional headwinds for precious metals are weighing on some of these industrial precious metals as well. Unquote. Looking forward, according to Kotak Securities in a note that they've sent out to their investors, quote, gold may continue to witness choppy trade as market players react to economic numbers, central bank comments, as well as virus situations and developments relating to China. But with increasing uncertainty, safe haven buying may keep prices supported, unquote. You see, ETF flows have also remained weak, signalling, of course, jitterness among investors. The holdings of the world's largest gold-backed exchange-traded fund, the SPDR Gold Trust, fell to 1,027.61 tons on Thursday. Maybe that should have given us an insight as to what could have happened on Friday. Now, brokerage firm Geojit said in a note, quote, initial bias for gold likely to be on the weaker side, but stiff support is placed at 1788. A direct break of which we've had, the momentum would continue in near term. Likewise, it required to break above 1835 to trigger recovery rallies in the counter. So we know where that's heading. It also added for silver the inability to move past the support of 2020, chances of recovery upticks are still on the cards. Meanwhile, an unexpected drop below that is a signal of long liquidation pressure. Now, on the positive side, Reuters reported today the US Senate will meet for the second weekend in a row on Saturday in hopes of passing a $1 trillion infrastructure bill that has struggled to overcome a series of last-minute delays and objections despite strong bipartisan support. support. If the vote succeeds, Senate Majority Leader Chuck Schumer will try to move quickly to pass the bill in what will be a major victory for President Joe Biden and a bipartisan group of senators who spent months crafting the package." Unquote. Now, should this pass, it should theoretically act as an additional tailwind for gold and silver. But of course, if it doesn't, then that support disappears. We're coming to the close of this video. The next 2 months are crucial for gold and silver prices. On the one hand, we see the Delta variant widening, and even China is reporting lower productivity because of it. On the other, we're seeing positive economic and job data news. And in the case of global uncertainty, whether one likes it or not, most investors will flock to the US dollar, which can only help strengthen it further and act as a headwind for gold and silver. We really need to see if the economic indicators continue to post positive or negative to ultimately determine which direction we can really expect to see gold and silver prices move, certainly in the short term. Whilst long term we remain bullish, the short term there are many clouds on the horizon. Monday morning will give us a strong indication, and frankly we can put an equal case for prices to move initially higher or lower, though we state here quite strongly that any upside very short term is limited, especially when you compare it to the potential downside very short term. We therefore envisage seeing gold trading somewhere between 1675 and 1825 next week, with as low as 1625 and as high as 1875 as outliers, though we're not so optimistic as to the 1875 upside. And we see silver trading between 2350 and 2550 as a norm, but we have to accept that 2250 is a possibility on the downside and 26 on the upside. If the stimulus bill is not passed today and economic data next week continues to be strong, then prices will obviously gravitate towards the lower end of our estimates. If it is passed and economic data is average or poor, then we can expect to see a move towards the mid and upper range of our forecast. Moving beyond that, frankly, it's really determined by the US dollar value, and if we see it hold above 93. If it does, we have further to fall. That's it. Thank you for listening. Please give us a thumbs up, whether you like the information or not. At least, hopefully, you will appreciate what we've put together here. Please subscribe. Please press the bell sign so you're notified of future videos. Sorry it's so long. And a quick shout out to our morning update, which we've published earlier, and which we will repeat tomorrow under a different thumbnail and heading. Thank you once again. Until next time. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.